Let's explore why super investors are buying Dollar General stock like crazy right now. Is it only the 52-week low price? Is it the belief that bringing Todd Vasos as CEO back from retirement a year ago will give new life to the company? Or is there more to the story? Well, today we are going to go through our 7-step analysis process to answer all of those questions. Dollar General is the largest American discount retailer operating around 20,000 stores. On average, they open approximately 3 new stores each day. Their locations are often found in towns with populations of 20,000 or fewer residents, targeting communities with annual household income of $40,000 or less. The company offers everyday essentials at competitive prices. And while we are talking about prices, let's mention the stock price as well. It is down by 70% from its peak at the end of 2022. And just last year, it lost over 45%. But why? We don't usually get a 70% discount without a catch. Well, they have a number of problems. Understaffing lowered costs, but also made stealing much easier, and they are losing 1% of revenue that way every year. Too few employees also results in poor customer experience. So they had to raise salaries and hire more people. And so the running costs are going up. Also, they are remodeling and relocating shops. All of this generates a lot of costs, so the financial results are down and the stock price follows. But those changes are made to create opportunities for the future of this company. So let's take a closer look at it. If you invested $1,000 in this company 10 years ago, you bought 15 shares. And today, they would be worth something close to $1,114. And this company also pays dividends. So in that time, you would get $190 as dividends. So if we add together the current value of shares and the dividends, we get $1,304. And that is a gain of 30% in 10 years. Not the best result. But if we would sell it near the peak around 2 years ago, the return would be closer to 270%. But that is all in the past, and we should look to the future. Individual insiders, that is an X, 0.3% of the company is owned by individual insiders. And we would like to see this number over 2%, so the management does not have its skin in the game. And are individual insiders buying? That is an X. There are some buy transactions, but overall we see much more sale transactions from individual insiders. And do super investors own this company? That is a check with 4 super investors, including Seth Klarman. It makes up 5.6% of his portfolio. Christopher Blomstrand, and it is his second biggest position, so a major bet, or Thomas Geithner. And are they buying right now? That is a check. All 4 super investors that own the shares of Dollar General were buying in the last quarter. So what do they see in this company? Return on invested capital, that is a check at 13.4% 10-year median returns. That is a very nice result. And what do we know about net profit margin? It is a check averaging 6.3% over 5 years, and the sector median is 4.2%. And now let's take a look at share buyback. It is a check. They bought back 32.1% of shares in the last 10 years. And the debt, it is an X. It would take 3.5 years to pay the long-term debt with a current free cash flow, and we want to see it under 2 years, so it is a problem. But overall, the financial health looks really decent. That is good, but let's also see how fast is this company growing. Revenue growth, that is an X at 8.3% 10-year compound annual growth rate. And we would like to see this number higher than 10%. So not great, but also not that bad. Free cash flow growth, that is an X at minus 3.2% in the last 10 years. So it looks bad. The main reason for such a result is investing in the company itself. In fiscal 2025, they plan to remodel over 4,000 stores. That costs a lot of money, and such investments will have a major effect on financial results in the coming years. And earnings per share growth, that is an X at 9.1% in the last 10 years. And also here, we would like to see it higher than 10%, so not bad, but not quite where we would like it to be. So they are investing in growth, but are they also distributing earnings to the shareholders? The dividend yield is 3.1%, so shareholders can expect to get $2.36 annually per every share. And the payout ratio, that is a check at 31.3%. And we want to see the payout ratio somewhere between 20 and 50%, so that is very nice. And what about dividend growth? It is also a check at 20.7% 5-year growth rate. Well, the dividend looks really nice, but now it's time to answer one of the most important questions. Is it cheap? Price to earnings ratio is 12.6. Not bad. But to calculate the intrinsic value of this company, we will use a discounted cash flow analysis. And if you would like to know how to value companies by yourself using 4 most commonly used models, then head over to stockinvesting.academy and choose our company valuation course. Okay, so first we have to estimate the growth of Dollar General for the next 10 years, and we will make 3 scenarios of this growth. So in the low one, we will estimate a growth of 3% for the first 5 years, and then 2%, in the medium 5%, and then 4%, and in the high scenario 7%, and then 6% growth. So the low scenario is close to the predicted growth of the industry, which is 2% for the next few years. Medium is showing a story in which Dollar General is outperforming its peers, and the high one is close to the growth we saw in the last decade. A bit slower, but not by much. So with such estimates, the intrinsic value in the low scenario is $76, in the medium $91, and in the high scenario $109. But we have to always apply a margin of safety to those prices. I use a 30% one. And with such a margin, we get in the low scenario $53, in the medium $64, and in the high one $76. And the current price is around $75. Dollar General is probably not that far from its fair value. But before we make any investment decisions, let's take a look at the big picture. Dollar General has a very nice dividend. It is a stable business that can do well in tough times when people are looking for bargains. And it is also investing in its own growth. So the future may be very bright. Oh, and it is buying back a lot of its shares. On the other hand, debt is not small, probably nothing extremely dangerous, but it certainly is not a great situation. And labor and regulatory challenges, for example, concerning minimum wage, can create some short or even long-term problems for the company. So let's open our Stock Ranking Pro and see the overview of Dollar General. As you can see, investor sentiment and dividends look really strong. Financial health is okay, but the growth is not impressive. But if we take a look at the history of this growth, we can start to understand this situation much better. Revenue is going up very nicely, so if that was the only thing we would concentrate on, then everything would look simple and obvious. But when we look at free cash flow, we see this rapid decline we talked about earlier. And also, earnings per share are recently a bit down. So the real question is, do we believe that those investments that caused the drop in free cash flow will generate so much growth that in the long term it will work out beautifully? Or do we believe that this discount retail model is just not sustainable in the long term because of labor costs going up all the time? Let me know what is your view on this situation, and see you in the next one.